Welcome to The Explainer. So today we're taking what might look like a bunch of abstract accounting formulas and, well, we're going to transform them into a highly practical toolkit for your business survival. We're shifting gears, moving into the world of managerial accounting, and we're going to map out exactly how your costs, your volume, and your profits all interlock to literally determine your fate.
It's the ultimate question, isn't it? How do you know if your business will actually survive? Because, let's face it, having a great product simply isn't enough. Poor pricing, misunderstanding your costs, flawed planning, that stuff can doom a business before it even opens its doors. But today, we're going to make sure that doesn't happen to you. We're going to give you the mathematical clarity to basically see into the future.
Okay, let's dive right into this. Here's our roadmap for the explainer. First, we'll establish a managerial mindset, then break down fixed and variable costs, master the contribution margin, run some cost-volume profit analysis, and finally, we'll find your ultimate break-even point. We really need to build this knowledge step by step to reach that crucial number.
So, starting off with Section 1, the managerial mindset, looking forward, not backward. To really use these tools, we have to completely shift our perspective from historical reporting to, future-focused planning.
Think about financial accounting, which is probably what you're most used to. It's built for external users, right? Investors, tax authorities. It looks backward, relies on strict regulations, and demands high accuracy about what already happened. But managerial accounting, which is our focus today, is strictly internal. It's highly pragmatic, forward-looking, and specifically designed to help managers make daily, critical, operational decisions. It's all about relevance for the future, not just the reliability of the past. You're no longer just keeping score here. You are calling the plays.
Moving right along to Section 2, Fixed and Variable Costs. We're calling this the lemonade stand breakdown. Basically, to effectively forecast the future of your business, you first need to understand how your costs behave as your activity levels change. Let's use a classic lemonade stand analogy to make this super concrete.
Now, every business has fundamentally different types of costs. Variable costs, like your lemons, sugar, water, and sales commissions, those change directly with the volume of lemonade sold. I mean, if you sell 100 cups, you need exactly 100 cups worth of lemons. Makes sense, right? Conversely, fixed costs, like the food truck, commercial blenders, employee salaries, and property taxes, those remain exactly the same regardless of your sales. Whether you sell one single cup or 1,000, your property tax and your truck payments, they don't flinch.
Visually, you can see how variable costs rise diagonally. The more units of activity, the proportionally higher the total cost. But fixed costs, they form a perfectly flat horizontal line. Now, I do need to give you a quick but absolutely crucial caveat. This flat line only holds true within a relevant range of capacity. Like if your lemonade stand suddenly goes viral and you need to sell the 1,000,000 cups, one truck just won't cut it. You're going to have to buy another one, which jumps your fixed costs up to a whole new level. But within your normal operating capacity, that line stays entirely flat.
And here's the real magic, and honestly, the kind of counterintuitive reality of cost behavior. While total fixed costs remain constant, your fixed cost per unit drops drastically as you sell more. Think about it. If your rent is $3,000 a month and you sell exactly 1 cup of lemonade, that single cup absorbs all $3,000 of fixed cost. Ouch. But sell 1,000 cups, your fixed cost drops to just $3 a cup. Meanwhile, the variable cost per unit stays exactly the same because 1 cup always requires the exact same amount of lemons.
All right, Section 3, the contribution margin, a better way to view income. We really need this because traditional income statements tend to mix these fixed and variable behaviors together, which, well, it can actually be incredibly dangerous for your daily decision-making.
Traditional income statements lump expenses into broad functional categories, completely hiding how they actually behave. If revenue drops by 20%, those rigid $30,000 fixed expenses, they don't shrink alongside it. And because of that hidden rigidity, a simple 20% drop in revenue causes a massive 80% plunge in operating income. The contribution margin format solves this blind spot. It explicitly separates out variable and fixed expenses, allowing you to actually see this risk coming way before it wreaks havoc on your bank account. So what exactly is it? The contribution margin is the amount remaining from sales revenues after variable expenses have been deducted. It's exactly what contributes to paying off your fixed costs, things like rent and salaries, before it ever turns into profit. Think of it kind of like this. Every single product you sell has a specific two-part job. First, it absolutely must pay for its own variable costs. Second, whatever is left over must contribute to this giant pool of fixed costs. Only after that pool is completely full do you actually see a dime of profit.
Let's jump to Section 4, Cost Volume Profit Analysis, running what-if scenarios. Now that we've got our contribution margin separated out, we unlock this massive superpower for managing the business.
Okay, let's walk through a baseline scenario together. Imagine our product sells for $15. It's got $9 in variable expenses. That yields a $6 contribution margin per unit. Multiply that by 8,000 units sold, and we have a total contribution margin of $48,000. Subtract our $40,000 in fixed costs, and boom, we're left with a nice, healthy $8,000 in operating income.
But what if we cut the price by $3 to boost volume from 8,000 all the way up to 13,000 units? As a manager, increasing your sales volume by 5,000 units seems like a guaranteed win, doesn't it? I mean, more sales means more money, right? Well, let's actually run the numbers.
Let's look at the harsh reality of the math here. By cutting the price to $12, our variable costs firmly stay at $9, dropping our contribution margin to just $3 per unit. Even though we're selling an impressive 13,000 units now, our total contribution margin is only $39,000, which means we can't even cover our $40,000 in fixed expenses. The business actually suffers a $1,000 loss. Volume went way up, but profitability completely tanked. And guys, this is exactly why you absolutely cannot manage a business on sales volume alone.
So let's rethink our approach. What if we combine that same $3 price cut with a $3,000 increase in fixed advertising expenses? If that aggressive marketing strategy pushes our volume all the way to 18,000 units, the math shifts entirely. 18,000 units times our $3 margin gives us $54,000. Even with our fixed costs now bumped up to $43,000 because of the ads, we ultimately secure a higher operating income of $11,000. That is the incredible power of cost-volume profit analysis. You can literally test these high-stakes decisions on paper before spending a single real dollar.
Which brings us to our final stop, Section 5, Finding the Break-Even Point, the magic number for survival. All of this analysis leads us right to this final, most critical concept, calculating the exact moment your business stops losing money and starts making a profit. $0. The break-even point occurs exactly when your total contribution margin equals your total fixed expenses, resulting in an operating income of exactly $0. At this specific moment, every single fixed cost has been covered by the margins of the products you've sold. Now, you aren't rich yet, but you are officially surviving.
And here is exactly how you find it. Break-even sales volume equals your fixed expenses divided by your unit contribution margin. For example, let's say you've got $45,000 in fixed expenses, and every unit you sell gives you a $4 contribution margin. You simply divide 45,000 by 4. You find that exactly 11,250 units must be sold to survive. If you sell 11,249, you're losing money. But sell 11,251, and you are officially a profitable business.
So you now know how to calculate your break-even point. But what is your margin of safety if the market shifts tomorrow? How far can your sales drop before you hit that $0 baseline? I highly encourage you to take these formulas and apply them immediately to your own business plans. Go ahead, run your own what-if scenarios, discover your contribution margins, and lock down your break-even point. That wraps up our explainer for today. Thank you so much for learning with me, and I'll catch you on the next one.